Okay, let's dive in. Imagine you're in Chennai, right? Busy streets, life happening, and bam, you need money. Like right now.
Happens all the time.
Maybe a medical emergency pops up, or, just making sure the bills get paid this month.
Yeah, the usual pressures.
And for so many people,
Mm,
the first thought isn't maybe a personal loan from the bank. It's that gold jewelry tucked away.
absolutely. That's safety net. Family gold, heirlooms sometimes. It's seen as instant cash, almost.
It's deeply cultural, isn't it? Gold is this reliable liquid thing you can fall back on.
Totally. Especially if your credit history isn't perfect or, getting a formal bank loan is just difficult. Gold is tangible. It's right there.
Exactly. But this whole system, this reliable gold loan pathway, it's actually seen some big shifts lately.
Yeah, things are changing.
It's all down to new rules from the Reserve Bank of India, the RBI,
Yeah.
and how banks and those other finance companies, the NBFCs, are reacting in Chennai. It's getting complicated.
Definitely complicated and maybe a bit tough for the borrowers themselves.
So what's the core change? What does the RBI actually do?
Well, the big one is the loan term, the tenure. If you were paying back monthly, you used to get maybe up to 36 months, 3 years.
Okay.
Now the RBI has slashed that. It's down to just 12 months.
Wow. Okay. 1 year instead of potentially 3. Why? What's the RBI trying to achieve?
Their stated goal is basically risk management.
Yeah.
They saw the gold loan market growing really fast and maybe got worried about, risky lending practices building up, trying to curb potential defaults down the line.
Right. So trying to cool things off, add some caution, makes sense from a system perspective.
Sure.
But for the person walking into that lender in Chennai with their necklace, it means a much, much tighter deadline to pay everything back.
Exactly. And think about who often relies on these loans. We mentioned people with maybe lower CIBIL scores.
Yeah, the creditworthiness score. If yours is low, other loan options might just be closed off.
Precisely. So for them, a gold loan isn't just plan B, it might be the only plan. It's their lifeline when things get tough.
It really is. It's often their main way, maybe their only way, to get credit quickly.
Mm-hmm.
Now, add another layer, the loan amount itself. Traditionally, you might get, up to 75% of the gold's value, the LTV ratio?
Yeah, 75% was the cap, loan to value.
But now, with these new rules and banks being maybe more cautious, we're hearing that borrowers are actually getting less. Sometimes, like only 45% or 50% of what the gold is worth.
That's happening, yeah. So you pledge your gold, expecting a certain amount based on its value.
And you walk out with maybe half that, and
Yeah.
you've only 12 months to pay it back.
It's like ordering a full meal and getting a small appetizer, but you still have to finish it super quickly.
That's a good way to put it. It puts immense pressure on people who are probably already struggling financially.
Absolutely. And this pressure, this new environment,
Yeah.
it's leading to some, let's call them creative responses from the lenders in Chennai.
Creative, yes. Ingenious, maybe? Or maybe a little worrying.
Yeah.
Banks and NBFCs seem to be finding ways to sort of work around these rules.
They're definitely adapting, finding ways to keep the gold loan business going while technically ticking the box for that 12-month limit. The spirit of the rule, though, maybe that's being bent a bit.
Okay, let's get into these strategies. What are they actually doing? I heard something about auto-debit shenanigans. What's that?
Right. So what some banks do is link your gold loan directly to your savings account. Standard practice, often.
Okay.
And they set up automatic debits, usually for the interest payments. Helps the bank get paid regularly.
Makes sense for them.
But if you miss a payment or maybe don't have enough for the interest that month,
No.
the system can just automatically pull the funds from your savings account anyway.
Wow. So money you thought was safe for, I don't know, rent or food could just disappear to cover the gold loan interest.
It can happen. And if you're operating on tight margins, that's a big problem.
Yeah, no kidding.
Yeah.
Okay, what else? There's this technical closure idea. Sounds a bit like financial magic trick.
It's interesting. So the rule says that loan tenure is 12 months, right?
Great.
So when a loan hits that 12-month mark, some institutions will, on paper, close the loan, mark it as finished in their system.
Okay. But the person still owes the money and the gold is still there.
Exactly. So almost immediately, sometimes the very same day, they issue a new loan agreement for the same amount, using the same gold as collateral, new paperwork, new loan number.
So they just reset the clock.
Pretty much. It keeps the loan off the overdue past 12 months list, but the borrower's situation hasn't actually changed. They still owe the money.
That feels like gaming this system a bit.
You could see it that way. We even heard from a manager at a private bank there who basically admitted their software wasn't even set up yet to enforce a supposed 24-hour gap the RBI wants between closing and repledging.
So they're moving faster than their own tech sometimes. What
Yeah.
about this family member swap? That sounds even more involved.
It is. Imagine a borrower is nearing the 12-month deadline, can't pay it all back.
Yeah.
Some banks are apparently helping them arrange for a family member, say a spouse or a sibling, to come in and take out a new loan.
Using the same goal.
Using the very same gold. The money from the new loan taken by the family member is used to pay off the original borrower's loan.
Huh. So the first person's off the hook, technically?
Technically. But the gold is still pledged, the debt still exists, just under a different family member's name now.
Wow. Like passing the parcel, but with debt. That could get complicated within families, I imagine.
You'd think so. But the one that really stood out was this auto settlement surprise, especially involving Indian Overseas Bank, IOB, in Chennai. That sounded quite aggressive.
Aggressive how? What happened?
Well, there were reports, specifically between around December 2024 and February 2025, that IOB was directly debiting the entire outstanding balance of gold loans from customers linked savings accounts.
The whole amount, not just interest.
The whole remaining principal and interest, apparently. And the really crucial part, without telling the customers beforehand.
Wait, seriously, no warning, just boom, the money's gone.
That's what was reported, people just suddenly finding huge chunks missing from their savings.
That's shocking. We heard about one specific case, didn't we? Someone in Ambatar?
Yes, exactly. This person apparently got an alert saying their gold loan was closed. Great news, maybe,
You'd think.
but then they check their account. And about 1.4 lakh rupees, it's a significant amount, had been debited from their salary account.
Just taken out.
Yeah. And it pushed their account deep into negative balance. This was just 2 days before their salary was due.
Oh, that's brutal timing.
And it gets worse. When the salary did come in, that was apparently automatically swallowed up too, to cover the remaining negative balance and loan amount.
So they were left with basically nothing right after payday because the bank decided to settle the loan without asking.
That seems to be the situation. You can imagine the stress. They had immediate bills to pay, household expenses.
Absolutely. What did they do?
They were really worried, especially about their credit score taking a hit, and they ended up having to pledge more gold, this time with a private lender, just to get cash for immediate needs.
So, solving one problem created another immediate crisis. What did IOB say about this? Did they respond?
They did. Their official line was that they were following RBI norms and acting to, quote, protect customers from overdue payments building up.
Protect them by taking all their money without warning.
Their spokesperson suggested that if a loan is overdue and there are enough funds in the linked account, the bank might recover the dues to help the customer avoid hurting their creditworthiness.
I can see the logic from the bank's risk perspective, maybe. But for the customer, it sounds less like protection and more like a seizure. Communication seems key there.
You'd think so. Consent, notification, seems pretty fundamental.
Okay, so these are ways banks are dealing with existing loans. What happens if someone simply can't repay within the new 12 months and these workarounds don't happen? Auctions, right? Are those faster now?
Yes, logically, if the loan term is shorter, the point at which an auction can be triggered arrives much sooner.
So auction acceleration.
Pretty much. Now, the process is supposed to be transparent. The borrower should be notified, the auction held locally at the Toluca level, and the borrower should even have a chance to bid to get their gold back.
That sounds fair on paper, but is that how it feels to the borrowers?
Maybe not always. There's this sense of anxiety, this feeling of, where's my gold going? The process might exist, but the communication or the feeling of control might be lacking for some. They worry about losing sentimental heirlooms without a real chance to intervene.
Right, the emotional value is huge too.
Yeah.
We heard from a manager at a nationalized bank, didn't we? What was their take?
Yeah, they were quite frank, said their customers were really struggling with the 12-month limit.
Really feeling the pinch.
Definitely. And worryingly, some were being forced to consider local moneylenders.
Oh, that's often a bad path. Very high interest rates, usually.
Exactly, just to avoid the auction. And this manager even mentioned suggesting that family member swap tactic we talked about as a sort of last resort for some desperate customers.
Wow. When a bank manager is suggesting that kind of workaround, it really shows the pressure people are under.
It really does. It highlights how these rules, aimed at protecting the financial system, might be pushing vulnerable people into even riskier situations.
Which brings us back to why people use gold loans. It's often because they don't have other choices, right?
Absolutely. As we said, low CIBIL scores, lack of other collateral. Gold is accessible, it requires minimal paperwork, it's fast. When other doors are shut, the gold loan counter is open.
But now, even that door is getting narrower. With these lower LTVs, getting only 45–50% of the value.
It means you need to pledge more gold to get the same amount of cash you might have gotten before, or you just get less cash overall.
Imagine needing, say, a lakh for something urgent. You have gold worth that much, maybe more, but you only walk away with 45,000 rupees.
And you have just 12 months to pay it back. It makes it much harder to cover significant costs. We heard that story about the borrower needing money for his wife's surgery.
Yeah, that was tough. It really grounds the problem. These aren't abstract financial issues. They hit people at incredibly vulnerable moments.
Precisely.
And those technical closures, they don't actually solve the borrower's underlying problem, do they?
Not at all. They just kick the can down the road for another 12 months. The debt is still there. It's a Band-Aid on a deeper issue.
It just creates a cycle of re-pledging, maybe even borrowing more if the bank allows it, like that manager hinted.
Exactly. The borrower isn't getting out of debt. They're just renewing it under slightly different paperwork, potentially at higher amounts if they need more cash later. And that lack of a 24-hour gap just makes it seamless, continuous debt.
So it seems like the banks and NBFCs have found ways to adapt, for now at least.
Mm-hmm.
But let's zoom out again. Why was the RBI so concerned in the first place? You mentioned market growth.
Yeah, the gold loan market had been growing incredibly fast. We're talking reaching something like 3.2 trillion rupees by late 2024. That's huge.
Trillion. Wow.
And banks, especially, were seeing really high growth rates in their gold loan portfolios. SBI, for instance, had a massive increase.
So the RBI saw this boom and thought, potential bubble?
Yeah.
Or just too much risk?
A bit of both, probably. Concerns about defaults ticking up if the economy shifted, worries about how accurately the gold was being valued, were lenders inflating values to give out bigger loans?
Okay, valuation practices.
And also, particularly with some NBFCs, concerns about large amounts of cash being dispersed over the official limits.
Right, there's a limit on cash, isn't there?
Yeah, ours 20,000. Anything above that should be through bank channels, but there were worries some weren't sticking to that.
So RBI wasn't just making this up. They'd seen issues before.
Oh, yeah. They took action against IFL Finance earlier, citing problems with their LTV ratios being too high sometimes and those high cash payouts.
So the new rules, the 75% LTV cap, the cash limit, transparent auctions, even saying gold should be valued with the customer present, these were all aimed at cleaning things up.
Exactly, trying to bring more discipline and transparency to a booming market, standardized practices.
But as we've seen, the medicine seems to be having some pretty harsh side effects for the patients, the borrowers.
That's the crux of it. The intention might be system stability, but the impact on the ground, especially for economically weaker borrowers who depend on the speed and simplicity of gold loans, it's proving difficult.
And you mentioned predictions of the market slowing down,
Yeah.
affecting NBFCs more.
Yeah. Analysts expect growth to slow. And NBFCs, which maybe have a higher tolerance for certain risks or serve customers banks might not, could feel the pinch more than the big banks. Think about companies like Muthoot Finance. This is their core business.
So looking ahead, what's the future for gold loans in India, especially in places like Chennai where it's so common?
Well, it feels like these RBI rules are a real double-edged sword, doesn't it?
How so?
On one side, yes, you're aiming for a safer financial system, less risk. That's important. But on the other side, you're potentially cutting off or making life much harder for vulnerable people who rely on this specific type of credit. It's a tough balance to strike.
And these loopholes, these workarounds the banks are using, they can't last forever, can they?
Probably not. They feel like temporary measures, ways to cope right now, technical closures, family swaps. They don't fix the basic problem that borrowers need more time or maybe more realistic loan amounts.
So what are borrowers in Chennai doing now, besides the workarounds?
Well, we're hearing they're exploring options, maybe looking at different private banks or NBFCs, Bajaj Finance, Aditya Birla Finance, or mentioned hoping for slightly better terms, perhaps.
Or worse.
Or worse, yeah. Turning to those local money lenders we talked about, which often comes with sky-high interest and aggressive collection tactics. It's not ideal.
It really brings back that feeling expressed by the Ambattur resident, like the system is playing games with you.
Yeah, that sense of frustration of feeling trapped by rules that don't seem to account for your reality, and there might be more rules coming.
Oh, like what?
The RBI floated some draft guidelines, I think back in April 2025, suggesting even stricter things, like monitoring how the loan money is actually used and use monitoring.
Wow. Tracking what you spend a gold loan on.
And potentially penalties for banks if they breach LTV limits. NBFCs were definitely not happy about those suggestions.
So the regulatory pressure might even increase. It's a really dynamic, complex situation.
It absolutely is. You've got these regulations changing the landscape, financial institutions adapting in sometimes questionable ways, and borrowers caught in the middle trying to navigate it all.
That safety net that gold loans represented, it feels like it's being pulled tighter, maybe even shrinking for some.
Yeah, the shorter terms, the lower LTVs,
Yeah.
even with the workarounds, it's creating real challenges for people who depend on this.
It really leaves you wondering about the long view, doesn't it? Are these rules achieving the right balance? Are they truly helping the most vulnerable in the long run? Or is it mainly about controlling the institutions?
That's the million-dollar question, isn't it? Or maybe the multi-trillion rupee question in this market.
It makes you think about the human cost behind the regulations, behind the big financial numbers.
Definitely. Maybe something for all of us to consider is, how do we design financial rules that do promote stability, but without unintentionally pushing the people with the fewest options into even tougher spots? Finding that balance is crucial.
A really important point to end on. Lots to think about there.